Good morning. Thank you for joining
Morning.
us. Uh, has anything changed in your approach, in your portfolio, in your outlook post the budget?
Not really. I thought the budget was a no-nonsense budget. The economy continues to open up. I think the first time in 2 years, my kids are going to school every week. So that's an undecided positive, if you ask me. Not just for my children, but children all across the country and the entire ecosystem of vendors which survives by catering to our schools. So the economy is improving. The fiscal position is better than I thought it would be. Honestly, I think that the budget painted a far better fiscal position than I thought it would be. The short-term items that you mentioned around oil prices and bond deals are there, but we've never really lost too much sleep about that. Our focus has been invest in strong, well-run companies and benefit from the underlying compounding and great franchises in this massive economy.
I fully endorse that idea. Saurabh, you don't look at macros when you invest. You look at individual companies and your understanding of the business. That's the unique aspect of Marcellus. But macros do matter. If cost of capital goes to 7 or 7.5, it will have an impact on demand. It will have an impact on valuations. It will have an impact on flows. At what point in time you would say that, look, while I continue to focus on micro, which is individual companies, the macro for me is something I cannot be now ignoring.
So, Nikunj, there's two ways to understand macro, right? The way we understand macro is the structural story. So, for example, India's 10-year government bond yield in 2004, 2005 was 17%. Today it is 6.7 and we are fretting that it might go to 7, right? So that for me is macro, that you have a structural downtrend over 10, 15 years, a 10 percentage points drop in your cost of capital. That's what transforms countries. And if I look at that structural type of macro, I don't see what I should exactly lose sleep about. The financialization of our country continues. Your channel, your viewers, our clients are all proof of that financialization. As financialization continues, cost of capital structurally continues to go down. Sure, there will be a Fed hike, 3 Fed hikes, 4 Fed hikes, but that's not going to be a structural story. Those are cyclical waves, and our job is not to second guess. And nobody who's watching this should be trying to second guess cyclical waves and trying to make money from that, because that is an absolute fool's errand. Focus on the structural story. Absolutely, macro matters, but structural stories matter. The cyclical stories, the noise is oil price, aaj kya hai, what will be the oil price next week, next month. That doesn't matter so much. It doesn't matter for two reasons. A, that is a mean reverting story. It's a cyclical story. There's plenty of noise in the oil price. And B, structurally, the oil price is not going to stay high, nor will it stay low. Oil prices structurally tend to hover around $50 to $80. So focus on macro stories which are structural rather than noise macro stories, rather than cyclical macro stories.
Saurabh, hi there. Morning. I'm going to get stock specific because the last time we interacted with you, you spoke about picking out stocks that have strong volume growth and are growing very strongly when it comes to their free cash flows. So, investing heavily in mid-caps, you said, like Astral Poly, Dr. Lal, Relaxo, Page Industries, etc. Could you just walk us through some of those names, tell us what the performance has been like, and if there's anything else within the mid-cap universe that you think fits this bill?
Right. So I think we've discussed building materials on several ET Now shows in the past. So let me focus on three other aspects of the mid-cap universe where we are investing fairly enthusiastically in our Rising Giants product. Two disclaimers. One, every stock I mentioned is a part of Marcellus's portfolio. And two, my money, my family's money, my parents' money is invested via Marcellus's products in these stocks. So just to be very clear about what I'm going to talk about. So the part of mid-cap where we are getting even more excited now than we were, say, 3 months ago is mid-cap lenders. With asset quality troubles for lenders largely behind them, we are seeing mid-cap lenders post not just loan book growth, but profitability growth, which is north of 25%. So Cholamandalam and Aavas financiers, we are building larger positions there than we hitherto had done. Also ICICI Lombard, I know it's not a lender, it's a general insurer. ICICI Lombard is a stock where we're continuing to build a larger position in our flagship product, which is consistent compounders. Moving on to a second area, specialty chemicals. It's been a big favorite of ours over the last couple of years. for obvious reasons, as input cost pressures have built up, there has been margin pressure in specialty chemicals. As I just said 5 minutes back, I reckon input cost pressures are transient. The volume growth and the market share gains that we are seeing Indian specialty chemicals deliver, I reckon are more structural. So our position build up in our mid-cap products now in companies like alkylamines and GMM Pfaudler continues apace. And the third area is the IT services space. TCS, long-standing favorite, but in mid-cap IT, L&T Technology Services continues to be a company where we're building a larger position. Similar story somewhat to financials. In mid-cap IT, specialist providers who can deliver 30-40% free cash flow growth, 20-30% PAT growth are not that common. Remember, the larger IT services companies find it hard to deliver 20-30% PAT growth consistently. We think L&T Technology Services has a product suite around engineering R&D, which will give it a solid 5-6 year growth runway, and hence that's part of our mid-cap build-up.
I know you flagged off mid-cap IT, but Saurabh, what about new age tech companies, the real hot space to be in? You saw a lot of fervor within this space in the first few months after their listing. Then they bore the brunt of the volatility in the equity markets, lots of selling pressure. When you think of names like Zomato, Paytm, Nykaa, PNB Fintech, etc., what's the outlook as to how they've performed and where you stand?
So we've had a look at last year's crop of IPOs. I think discussed on your channels that we've been looking at last year's IPOs quite carefully. Honestly, the tech names, we haven't yet been able to convince ourselves that there are sustainable competitive advantages there. We are very conventional, old-fashioned investors. If we don't see even, say, forget free cash flows, forget profitability, if we can't even see operating margins, then it's very difficult to convince ourselves there's a franchise there. Sure, you've raised a lot of money and you've built whatever GMV or whatever the metrics are. But if you're not able to deliver operating profitability, then difficult for us to convince ourselves you've built a franchise. We've done a fair bit of granular analysis actually as to why many of these companies are not able to deliver operating profits. And our reckoning is many of these franchises are flattering to deceive. Ironically, out of the IPOs last year, the one that we have built a substantial position is Tarsans. It's a provider of lab equipment and equipment to the diagnostic labs. So Dr. Lal Path Labs, for example, used to be a Tarsans customer. So Tarsans has built a business with 50% EBITDA margins, 30% PAT margins in an industry which is around 1,200 crores. But as the specialty chemicals industry and the pharma industry grows, we reckon the lab equipment space will grow similarly because they'll supply to the specialty chemicals companies who in turn will supply to the pharma companies. Tarsans is the dominant player in this lab market. It's a small company today, 300 crore top line, but 30% PAT margins, and our discussions with dealers and distributors of Tarsans suggest that this is a well-run, moated company with very few competitors in the Indian market.
Good morning, Saurabh. This is Nantara. So when you were talking about the new stocks and, you gave the disclosure as well, but with the new stock ideas that you talked about, I couldn't help but notice the new hot pack at the moment, the metal story, was missing from that. Are these not great franchises that are being built with decarbonization being the theme around the world? I know the jury is divided when it comes to this story.
So in a way, this goes back to the beginning of our discussion with Nikunj, right? With any metals and mining company, right? Not just in India, the world over, right? Any metals and mining company, it's very difficult for them to decouple themselves from the global commodity cycle. Typically, the share price of these companies has a 70% correlation with the underlying metal prices on the London Metal Exchange. So effectively, when you buy a metals and mining company, you are basically betting on the LME metal price, which to my mind is not a area where we in Marcellus have any competitive advantage. How are we supposed to predict metal prices 6 months hence, 12 months hence? And if we can't do that, we can't really take our clients' money and invest it in these stocks.
Okay, so you're staying out of the metal story. I thought I'd ask you this because it just turned out to be a hot pack. The other thing, Saurabh, I wanted to ask you about, you've spoken a lot about, for example, the great franchise of HDFC Bank, how it has been building up its market share, etc. But the HDFC Group, whether in 2021 or the early signs of it in this year, not so encouraging, right? On the other hand, you've got public sector banks like an SBI, which has outperformed the market. The expectation is the public sector banks will be outperforming. Will you be making adjustments in your portfolio, or is this a space that you would be looking at, especially when the other franchise you bet on in the financial space is Bajaj Finserv, but we've been talking so much about PE compressions as well?
So I've lived in India now for 13 years. I've looked at SBI's numbers for last 20 years, going back 20 years. I haven't seen them deliver a return on equity above their cost of equity in this century. So when they do so, we'll obviously be happy to have a look, because again, staying with fundamentals, difficult to take the money from hardworking families and say, I will take your money and I'll invest it in a bank which doesn't deliver a return on equity above cost of equity. On the other hand, let's focus on HDFC Bank. They have gained more market share than the entire private sector banking space plus SBI put together in the last 3 years. 3 years ago, market share was 7%. Today, it's 10%. Add up all the private sector banks, add up SBI in the 3 years, they haven't got remotely close to HDFC Bank. Asset quality, net NPAs, different league to any other large private sector bank or to SBI. Net interest margins, obviously very good because of their famous CASA franchise. So, unless I'm very, very obsessed about short-term movements, I don't see why we and Marcellus or indeed anybody else holding HDFC bank shares out there should lose sleep. Impeccable operating performance quarter after quarter, and 3% market share gains in 3 years, 3% market share gain in 3 years. I haven't seen any bank do that anywhere in the world. That is phenomenal. At this scale, to go from 7% to 10% through COVID, through the disruptions we had, is phenomenal. Just to put it in perspective, Kotak Bank's market share is 2.5%. That means in the last 3 years, HDFC Bank has added on a bank much larger than Kotak Bank. But obviously those who focus in the work in the stock market focus on noise and news flow. We don't do that. We focus on the fundamentals and keep our eye on the ball.
So just for the benefit of our viewers, I know we've discussed this much, but this topic keeps on coming out again and again. There's nothing wrong in buying good quality businesses, but good quality businesses may not be this great stock. And the classic example, which you've spoken about, which you've defended, which I've defended, which everybody knows, but for those who don't know, is that Unilever example. भाई एक समय था Unilever 10 साल time wise correction में गया. Company went through okay growth, but the stock did nothing. Could that be the story for HDFC Bank? Because last 2 years in a bull market, the stock has underperformed. Last 1 year returns are negative.
So people keep citing these stories. I think another one story I keep getting is Infosys ka share price in 2008 was the same share price that it had in the year 2000. And we keep hearing these stories. If you see the Indian market in the last 20 years, you and I will struggle to find any company, and I'm happy for people out there to send us proof in emails. In the last 20 years, I haven't found any company in the Indian market where PAT grows at 20% year after year and the share price doesn't grow, for obvious reasons, right? If a company is delivering PAT growth of 20% year after year, then every 4 years, basically the company is doubling the business, doubling the PAT, and it'll be crazy for the stock market not to take heed. What you do get, Nikunj, I completely admit, is if a great franchise becomes a mediocre franchise, if a great franchise underperforms from a business perspective, the PAT stops growing at 20%, the PAT becomes single-digit PAT growth, then obviously the share price stagnates. So the point we all have to recognize is if we from an investment perspective, if we get the quality wrong, i.e. we thought this is a great franchise, but actually it's a mediocre franchise, then of course it will underperform. And that's the main risk to our style of investing. And it's a risk we have to be very vigilant about, that we are genuinely investing in companies which continue to be producing great results. And if the results are mediocre over an extended period, obviously we will underperform. And that's the reason I focus on the business rather than focusing on the stock price. The stock price tells us nothing. It's one of the biggest ironies of investing. The stock price has zero information value.
How will LIC IPO change the dynamics for the life insurance sector? Why I'm asking you this because you own HDFC Life. Why I'm asking you this is because this is one sector where you had a COVID pain. This is one sector where insurance companies are struggling to increase premiums also.
Right. So if you see, let's take address both issues. LIC's market share losses vis-a-vis the private sector life insurers are a very similar story to say how public sector lenders have lost market share to the private sector lenders, right? So it's a repeat of basically the same paradigm in life insurance. We're seeing a replay of what's happened to the public sector banks over the last 20 years. But as we are also discussing, SBI remains a formidable lender, and therefore, by the same token, LIC remains a formidable life insurer. So I'm not so sure the IPO will change the operating dynamics in the life insurance industry. You know, the interaction that with the manufacturers have with the distribution and the dealership community. And I don't think the public's perception of LIC will change. But the public's perception is LIC is a sound insurer, a reliable insurer. And I think that perception will sustain very nicely for the years to come. Vis-a-vis HDFC Life, growth in embedded value, growth in premiums has been solid. So even the month of January, which was a pretty soft month for other insurers, and as you are alluding to, recent quarters have been soft for other life insurers. HDFC's growth in embedded value, the growth in profitability in the business has been very steady, around the 20% mark, and we have, you know, we've really nothing but admiration for the way the operations of the business have been run by Vibha and the broader team at HDFC Life. Amitabh Chaturvedi in his HDFC Life years did a fabulous job. I think Vibha and team have taken it forward. Operating metrics are impeccable, and to our mind, this is a class apart. HDFC Life is a class apart in Indian life insurance, much like HDFC Bank in the context of private sector banks.
Saurabh, we've discussed banking names, you discussed specialty chemicals, you discussed why you're not looking too much into macros as well. But I would like to just ask you a little bit about the consumer names and the franchises that you've been betting on, right? From a Titan to a Pidilite. We've seen the third quarter numbers as well. Inflation is on the rise. There is all this talk of PE compressions. Are you still going to bet on the consumer stories with these and Nestle's, or how are you doing it?
Yes, so I think again, the performance is self-explanatory. I think Titan, even if you take a 2-year CAGR, look through COVID, because COVID obviously flatters the performance of Titan. Even if you do a 2-year CAGR, I think the business is doing top line and bottom line growing at 25-30%. And remember, Titan's grown free cash flows at 30% CAGR for 20 years. Similarly, Pidilite, actually, interestingly, the two firms you mentioned have grown free cash flows at 30% CAGR for 20 years. That means they've grown free cash flows around 150x over the last 20 years. This is just incredible. I doubt too many companies in the world can claim what Titan and Pidilite can claim, that they've grown 150-fold in 20 years. Now, Pidilite's case, operating performance is solid. I think they did around 20%, excluding the acquisitions. They're gunning out around 20% growth in operating profitability. Yes, there is input cost pressure on Pidilite. But that's again transient. I don't think VAM prices will carry on sustaining at these levels. The input cost pressures are transient. The market share gains, the efficiency improvements are structural. That has really been Pidilite's story for the last 10-15 years. Consistent improvement in working capital cycles, improvement in operating cash flow, driven by underlying efficiency improvements. It's a leaner, fitter business than it was 10 years ago, and that's what makes us money. If a business is growing, let's say conservatively 10x in 10 years, 25% cash flow compounding means 10x growth in 10 years. Even if the PE multiples moves a little bit either other, we're not going to lose sleep. The focus on businesses which can do 10x in 10 years in terms of free cash flow compounding. Let the PE multiple, the merchants, focus on their PE multiples.
Okay, so that's how Saurabh Mukherjea says he plays 2020 cricket with the mindset of a test player. Thanks so much for joining us live today on The Market. Always a pleasure to host you. For an earnings call now, we're going to do that